Yeah, so we are all very pleased to have Professor Kirti Sinha from UT Dallas. She's going to talk about the real effects of coordination failure between accounting and other regulators. And so thanks. Over to you, Kirti. Like I said, first 5 minutes, we won't interrupt. And then people can ask questions. And if people want, they can either raise their hands or send me a message and I'll prompt. Thanks.
Okay.
Or you can ask directly also. I think it's a small group, so
sure.
Feel free to jump. Yeah. Thanks, Kirti. Thanks for coming.
Thank you, Professor Srini. And I think it is my pleasure to be presenting this paper at my alma mater. I graduated a long time ago in 2008 from IIMB Bangalore, and then I did my PhD here at Kellogg School of Management, and now I'm currently assistant professor at UT Dallas. And today's paper is a joint work with Riddha Basu, who is my Kellogg colleague. We were in the same cohort at Kellogg. He's currently at George Washington University, and Sugata Roy Chaudhary, who is a professor at Kellogg School of Management. Today's paper, I'm going to talk about real effects of coordination failure between accounting and prudential regulators. So a quick overview just to set up the stage. So essentially, we are trying to see if there is some sort of failure in coordination among different type of regulators. Are there any real economic consequences of that? And specifically, one of the regulators that we are focusing on are the accounting regulators, and the other ones are the banking regulators. The reason why we are looking at this question is because it has been a very big debate for a very long time about decoupling of GAAP. GAAP is basically the US GAAP, generally accepted accounting principles, decoupling of GAAP and prudential regulations. This debate was quite heated around the time of the financial crisis, where a lot of people blamed mark-to-market accounting and other accounting standards that exaggerated the extent of the financial crisis. And in fact, if you look at the theoretical literature, there are several papers that have tried to examine the effect of how regulators interact with each other and what are the implications. But in terms of empirical evidence, there is still not much that we can learn from. And finally, in order to answer this question, we look at the introduction of current expected credit loss model that US GAAP or FASB has recently introduced. And we look at the introduction. We are not really looking at the implementation of CECL. We are talking about the introduction itself, even though the implementation was years away. And we see that how does that introduction affect lending terms for banks relative to non-banks, and as well as investments for the firms who are exclusively dependent on banks. And as I said, the objective is to see if the lack of coordination between accounting regulators, which is FASB in the US, Financial Accounting Standards Board, and the prudential regulators, which I'm going to talk about in the next slide, had any negative impact on the economy overall. So a quick overview of how bank regulatory framework works in the US. Again, I haven't really put all the regulators here. I've just put the major regulators. So there is a bank which is regulated by the Fed. So Fed is, is a macro regulator. Then there are a couple of micro regulators such as OCC. Actually, Fed, you can think of it like RBI, but it is not just like one institute like RBI. It has like several board of governors, etc. as well. But it's kind of equivalent to RBI in India. Then you have OCC and FDIC, which is Office of the Comptroller of Currency, and Federal Deposit Insurance Corporation, which is more of a micro banking regulators. And then you have a couple of other regulators like, Bureau of Consumer Protection and Federal Housing Finance Authority that is looking at like specific financing institutions. And finally, of course, there is SEC. SEC is again equivalent of SEBI in India, so which is the Securities and Exchange Commission, which interacts with FASB, which is the Accounting Standards Board, and decides regulations for bank in terms of how their reporting should be. And if you look at the regulatory objectives, it's very different for different type of regulators. So if you look at Fed, which is the macro regulator, they are more interested in the stability of the financial system, right? So they don't really care about the individual banks, whether they are surviving or not. They are mostly talking about the overall financial system in the US. Then the micro regulators such as OCC, etc., are focused on stability of individual financial institutions. So they have instituted several tests, such as like stress test and etc., to identify if there are issues with a particular bank or a financial institution. And when you come to accounting regulators, their major objective is investor protection. It's all about information that goes out to investors, and and the decisions that the investors can take based on that information. So these are the regulatory objectives. So based on this, we started wondering how important it is, that these regulators coordinate amongst each other. And because, there can be consequences for the banking system, and therefore can have implications for the real economy, for the firms who are dependent on on banks. So this paper, we are focusing on these three banking regulators, and we together call them prudential regulators, and how they interact with the the SEC FASB combination, or the accounting standard setters.
Hi, Kirti, I have a question for you.
Sure.
Or a comment, actually, a few things.
Sure.
Just one, when I read the introduction, and now that I've listened to what you just said, it seems like it'll be helpful for you to talk a little bit about, given that you're talking about loan loss reserves, etc.
Yes.
Right. So if you go through the Fed website or the FDIC website, OCC website, historically, have they been involved with this particular issue, or broadly with respect to accounting? Right. So that kind of sets the stage. For example, if you say the Fed has never been involved with accounting issues, or FDIC has never been issued, then it comes as no surprise what you find. Right? The fact that it's not in there, because you set it up the way you set it up, you said their purview is stability. I don't know if you want to do it like that. Right. So you, right. So you want to give the reader a little bit of background into, have they ever been involved in accounting decisions? That's one thing. Okay. The second one is more like a qualitative comment. When I read the word failure, it seemed a little bit of an extreme, maybe semantic. So because the time period is about 2 years, right, for them to, before the Fed, these three came out with a statement. Now, if you compare it with something like the revenue recognition standard, where two accounting regulators, IASB and FASB, have been going at it for 10 to 12 years, it's not much of a failure in the sense that it took 2 years. Sure, your results show that there's been some cost to banking, but to call it a coordination failure seems a little bit extreme in my opinion. Right? That's just, of course, it's, that word coordination failure is there in the economics literature, but it seems a little inappropriate given the context and given the time period, right? So whether you want to tone it down is up to you, but I just want to share my view.
That's absolutely, actually, thank you so much. And, in the next slide, to answer your first comment, where you said that, have Fed or any prudential regulators been involved in the accounting rulemaking or not? So I'll just give you like 2 quotes here, and where it's not that, like, they have not been involved, but that's what they have been saying, that we want this kind of involvement. Like, for example, when here the FASB chairman wanted to decouple FASB completely from prudential regulators, and they said that you should not handcuff us and let us do our job independently. And at the same time, the FDIC chairwoman Sheila Blair says that if we let them do everything on their own, that it's going to be very, very detrimental to the to the banking world. So again, it is more of like anecdotal evidences here and there that I've found, but I think it's a very great comment that we can include it in our introduction and motivation, so that readers also understand what role or how regulators have interacted in the past with standard setters.
It creates like a prior for you, right? And then the data gives you data plus prior gives you the posterior. So that's the sense. Otherwise, I'm going and not knowing what to expect.
That's absolutely right. And for the second comment, I again agree. In fact, we have changed that word so many times. And as I said, this is a brand new paper. This is the first time I'm presenting it. In fact, nobody's presented, like Riddha or Sugato. We are presenting it for the first time. In fact, earlier we were using misalignment. And then we said, no, we don't like that word. So we said, okay, should we say coordination failure? So, but I'm really, really open and, to this suggestion. And I understand where you're coming from, because we have had this tussle as well. So we'll keep thinking and, throughout. Thank you for your comments. So, and this is what I was just giving this, financial crisis particularly was such a big example where, people were blaming accounting standards that, it happened because of mark-to-market accounting and etc. And at that time, Robert Hers was like a very, very, forceful FASB chairman, who was always wanted that, FASB should be like independent and should decide what is best for investors and should not be, there shouldn't be any it should be like decoupled completely from other regulators. But at the same time, at least FDIC said that, we can't do that. They have to consult with us. Otherwise, it can have negative implications. So, if I were to talk about the big research question in this paper, if it was a perfect world where, every regulator was just doing their independent operation, prudential regulators will use their tools. They will, figure out the financial stability. Accounting standard setters would also, use their tools for investor protection. But in the real world, we see that it is not independent. It's a coordinated operation. So whatever policies or the tools that these two set of regulators are using, they interact with each other and then has implications for financial stability as well as investor protection. So in this paper, the big picture research question, therefore, is how does this interaction, if it fails, again, it's a very strong word, I agree, but how does it affect the real economy? And as I was saying earlier, if you look at the literature, there are some papers that have theoretically examined the effect of regulatory coordination or failure on the banking system, or also on maybe like firm investments as well. For example, there's this AEJ paper, which is a very recent paper, where they look at the interaction between micro and macro prudential regulators. So they're looking at Fed versus OCC and FDIC. In accounting, again, there is a lot of theoretical literature. I'm not going to spend a lot of time, in the interest of time, I'm not going to go into each of these papers, but I just want to mention this particular last set of papers, which are recent working papers by, both by actually Harish Sapra and other co-authors. They are looking at the interplay between accounting and prudential regulation. And one of their major findings is that you cannot just set accounting standards without having to change any capital regulatory requirements. So this, in fact, was the paper which kind of made me think about, this particular question and led me to do this empirical analysis. And as I said, the empirical evidence is scarce. So that's the reason we decided to, work on this paper. So the specific research question, I'll give you a little background. So what we are trying to do here is, FASB in 2016 announced that current expected credit loss model, they announced this new standard in 2016, which was supposed to replace the incurred loss model in 2019. Of course, due to COVID, it was extended to 2020. But when they announced it, we argue that they did not really talk a lot with the prudential regulators about it. And I'll tell you why. Like, there is some anecdotal evidence that I'm going to share in the next few slides. And we say that prudential regulators did not give enough inputs for the CECL mandate, which kind of created uncertainty for banks about implementation of CECL. So let me remind you, this happened in 2016, and the implementation was supposed to happen a few years later. So I'm not talking about, how the standard affected the banking industry. I'm talking about just the announcement of CECL and how its implementation would eventually affect bank lending or banking system is what we are trying to study here. So we say that it created some sort of uncertainty because banks were not sure that how to implement it without affecting their regulatory capital as well as their stress testing requirement. And therefore, they tightened their lending term and they affected firm investments. So the research question, the specific research question is, the introduction of using the introduction of CECL standard, we examine whether uncertainty due to lack of coordination between accounting setters and bank regulators affect bank lending practices and subsequently affecting firm investments.
So again, I have a question here before we look at the results. I guess it's a sort of an identification question. Suppose we live in a world where there's no prudential regulator, right? Mm-hmm. And FASB issues a statement, and then you find the result you have. I'm wondering if you'll get the same result. In other words, why do you attribute this to the lack of coordination as opposed to the normal operation? Like the FASB announced that it's going to take 2 years to implement, right? And so whether you have the prudential regulators or not, I know you have an endpoint. It just happened that you have an endpoint where the regulators came in and said, yeah, right? So the ideal test is, suppose we live in an alternative universe, a parallel universe, where they did not come and say anything. What would have happened versus what happened, right? So that's kind of, that would identify and say that this whole thing was because of the lack of coordination. Right?
Yes.
So how would you kind of identify it more carefully is what my question is.
That's absolutely right. And and that's one of the reasons I'll show you, like, we are using 2 types of research designs. And we actually show a reversal right after the Fed comes in and says something. We show like there is a reversal, right? So at that point, it's not like there is a new information coming in apart from what prudential regulators are saying. So that's one. And second, like we have actually relied on a lot of anecdotal evidence. I completely agree with you. Every time FASB announces a new standard, there is a lot of discussion around it, and there's a lot of issues that people talk about. So we have kind of tried to use 2 things. One is the anecdotal evidence, which I'm going to show in the slides a little bit. And second is that we have divided the period in the uncertainty period and a resolution period, and we show that things actually reverse. So
I mean, this is kind of very impossible to test, but the thing is, I'm trying to say there is an uncertainty about the uncertainty, whether what the market or the banks or the we really don't know what the uncertainty is. And then when you find it exposed that this regulator came in and said something, and therefore there was a reversal. It's a
I agree. I think I agree. I think I probably.
But it's a hard thing to crack. But I'm just saying that it's just something to be aware of. That's all.
Yes. No, I think that's in fact, this is again, I'm glad that you were talking about these points, because I think like Hriday is here as well, and he knows that how much we have talked about it, that, how do we identify this? It's coming because of this, right? I mean, that was, and we have tried, like, you will see that we are using, non-banks. We're like trying to do a lot of things to tease out the causal impact. But I still agree, like, I agree with what you're saying, and probably like we need to be like cautious of how we, or set up this identification, or maybe at least improve it a little bit more. But this is something that something that we have thought about a lot as well.
So I was just to make it a little bit more compelling. Maybe if you do a fact-diverse search of all the news stories from day 1 till the resolution date, something along those lines, may, kind of. Whenever there's a news story about this particular standard, then investors are aware, and then the market reaction test can be extended. So that will give us a little bit more confidence that some people at least care about this and are reacting to the evolution of uncertainty. Is what I'm trying to say.
I think that's interesting, and probably like I will show you a couple of those snippets here as well. Like, I mean, which we tried to find. Like, we didn't use Factiva, but we tried to like look at some articles and try to see what people were talking about. I'm just gonna show you some of the comments as well. So just a preview of main results. What we find is that compared to non-banks, banks significantly reduce lending and they impose stricter loan terms. And I'm looking at loan terms such as the spread, collateral as well. We look at maturity, we don't get anything on maturity particularly. And then finally, we look at the real effects where we examine the borrower that are exclusively dependent on banks and how does it affect their investment during this uncertainty period. Yes, Vamsi.
Hello, hi. I have a doubt with the lines. So you wrote the regulations are it took around 4 months. So it's like wouldn't the regulate?
Vamsi,
like,
your audio is not clear to me. I don't know if you're breaking a lot. Yeah, try again.
Yeah. Am I audible?
It's like breaking in between, so I can't. Do you want to like type in your questions and maybe Srini can ask?
I do that.
Yeah.
Why don't you go until you? You can keep going till he types his question.
Okay. And so what is a current expected credit loss model? It is essentially, again, there are several things attached to it, but one of the major things about CECL model compared to the existing incurred loss model is that it requires the estimate of loan loss reserves for the entire lifetime of a loan. So it kind of increases the loan loss reserve significantly compared to the incurred loss model. Under the incurred loss model, you estimate loan loss reserve based on your historical, default rates, etc. have been. But in this case, you have to estimate it for the lifetime. So, if you particularly think about a mortgage, which is like a 30-year loan. So if you were to estimate a loan loss reserve for, considering those entire 30 years, it's a really, really huge jump. So one of the biggest concern that banks raised was that the day one effect, and this is what I'm talking about. The day you implement CECL, suddenly your reserves are going to shoot up significantly just because of the way CECL has been designed. And if your loan loss reserves increase, it has adverse implications for your regulatory capital. So and CECL, another thing about CECL is that when you are estimating those loan loss reserves, you also need to figure out the economic environment and make adjustment to your loan loss reserve. So if you think the economic environment is bad, the loan loss reserves will further go up. So banks said that, we are in 2016, in 2019, you're going to implement this standard. I don't know what's going to happen in 2019. And frankly, what happened is eventually the date moved from 2019 to 2020 and COVID hit. So it was such a perfect example that at that time, the economic environment was so uncertain that CECL implementation would have, if Fed hadn't made any changes, CECL introduction would have had such catastrophic effect on the lending system. And then, these big banks, they also have to go through these stress testing cycles, which, Fed and the OCC and FDIC have put in. So they said that, there are effects for regulatory capital and they will also breach their stress testing requirements. So there was this big debate. And after a lot of discussions, the banking organization's concerns were heard by Fed, like they actually conducted a lot of meetings, etc. And then Fed, OCC, and FDIC issued clarification where they said that you have an option to phase in the day one adverse effect of CECL for over a three-year period.
Yeah, Vamsi's question is available now. Kirti, can I read it out?
Yes,
so Vamsi says there's a timeline gap of 4 years between the announcement and the implementation. So can it actually be a lack of coordination because the regulators would go through the new guidelines as soon as they are out?
Okay. So
I think he's questioning whether there's why it's almost. I think he's saying that it's like a normal thing. It's not a lack of coordination. It's just like normal evolution of
any announcement. I think, yeah, I think that's what he's talking about. Yes. So I think, Vamsi, again, I think this is also relates to what, Professor Srini was saying earlier, is because that, I think it is a typical cycle of any new standard which comes in our case. And that's why we rely on, a couple of tests to say that this is exactly what's happening. Like one, as I said, we do like separate samples, but that could also, you may say that, that happened because of just again, the evolution of that standard. We do look at like market reaction of banks and non-banks at the same time. And then we rely on anecdotal evidence, but point well taken. I think this is something we probably need to, tease out a bit more. Let's see, I mean, we have tried to do the best we can. But we are at the back of our head, we are definitely aware of this concern. And I hope that answers.
Please go ahead, yeah.
Okay.
Please go ahead, yeah.
Okay. So here is a quick timeline. So as I said, in 2016, the FASB issued ASU 2016-13 CECL mandate. And in December 2018 is when Fed provided clarification. And the eventual implementation was from March 2020. So we call this period between 2016 and 2018 as the uncertainty period. And our predictions are that during the uncertainty period, banks would, make their lending terms more stricter. So the loan amount should go down, interest will go up, collateral requirements will go up. And specifically for collateral, what happens is like if you have higher collateral, you have to have you can have less reserves, right? So there's like a direct correlation between loan loss reserves and the requirement of collateral. Because, for example, in case of mortgages, because they are typically backed heavily by a collateral, your loan loss reserves are much smaller. So we say that because of uncertainty, banks may also increase their collateral requirement. And then because you require the entire lifetime of losses, you may want to decrease the maturity as well. So those are our predictions. And then further, we examine whether these stricter bank lending terms affect firm investments in the real economy, explicitly for firms that are dependent on banks. And here are some anecdotal.
Yeah, sorry, I have a question.
Sure.
About the second part, the investments part. It kind of threw me off when I saw it. I always think in terms of if you lose one source of financing. I heard you say one thing about very bank-centered, right? But still, even if they are, there's nothing to prevent these firms from going out to other sources of financing, right? So have you considered cutting the sample into financially constrained, unconstrained? I didn't read that much of the paper, but I'm wondering if you did that, because it seems surprising that something like this would cause firms, the borrowers, to give up investment opportunities, right? So it seems like a real cost, and
yes,
that seems too a little bit strong for me. Right? You would always search for either sell off some assets or do other things, etc. Right? So why would you cut your investments if you have good growth opportunities and you're unconstrained?
Yes. So I think in terms of like what we have done is one of the cross-sectional tests we use is whether firms are rated in the public debt markets or not. So we say that like, that's kind of a proxy for as a financial constraint that you cannot go to the public debt markets. And but again, we can definitely use other financial constraint proxies, like, there are those KZ indexes and like several others that we can use. But right now, what we say is that if you are rated on public, if you have a public debt rating available, that means that you have access to the public debt market, bonds, etc. So in that case, you should not be impacted, and or you'll have less impact compared to the ones that are not rated. So that's one cross-sectional test that we do.
Yeah. No, the reason I'm saying is it seems like if the investments went down, I'm just being a little playing devil's advocate.
Yes,
here.
no. Yes, I agree.
It seems like something else must be going on, and not this particular event. So it's an attribution issue, I'm saying, right? Yes. So they cut in banks. I believe banks may have cut down their loans, make their terms stricter, but for the borrowers also to cut down seems a little difficult for me to believe. And so if they did cut down, it might either they didn't cut down or they did something else, or if they did cut down, then that reason for it must be some other reason,
something else,
something else that's going on at the same period, right? Seems a little, that's my, conjecture, of course.
I agree. And in fact, like, again, to the best of our ability, like, that's what we have tried to identify if it is happening. So one of the things, as I said, that we have done these cross-sectional tests, we have looked at, they also divided borrowers in terms of size. So we are saying the small borrowers probably don't have as many, borrowing opportunities as big borrowers. So we did that cross-sectional test. And then we also, as I said, we are comparing firms that are exclusively dependent on banks compared to the firms that are not, which means that they have access to other lenders as well. So, but again, very really relevant question. Like, this is something that we thought about. Like, we're like, okay, what can we do? What can we do to tease out? But I like your suggestions, and we can probably do more on financial constraint sides, or again, try to add some more cross-sectional tests. Maybe like that will help us understand like what's really happening.
Yeah, so Varun has a question and Jaydev has some comments. I'll just read it out. Jaydev says public debt market may provide resources, I think alternative financing. And here's a question whether lending SME firms are affected as these have little access to public debt. So I think one more cross-sectional cut, I guess.
Based on SMEs. Yeah, okay. That's interesting. I hope Riddha is noting them down.
Yeah,
so
Varun,
yes. Yeah, so I have one curious question.
Sure.
Whether you check, whether investments by firms with more intangible assets are affected more. Right?
That's it's a work in progress. We are actually doing that. We are creating a proxy of something called tangibility. And we are saying that if you have more tangible assets that you can put as use as collateral, then you probably can still, borrow. So that's, yes. So that's happening.
Okay, great. Anyways, you are doing it. Yeah, great.
Okay, thank you. Okay, so here are some anecdotal evidence, like based on what we have discussed. Like I've put some here on slides. So for example, this is the CFO of Capital One Financial Corporation. And what he specifically said, like this was again, when the standard had been issued, and then there were some congressional hearings as well, etc. And where he came and he said that CECL is duplicative of other far more effective tools such as Basel III and capital stress testing regimes of Dodd-Frank Act. For people who don't know, Dodd-Frank Act was basically the major act that came into place after the financial crisis. And its objective was to make sure that, banks were adhering to safe lending practices and overall like safe practices to ensure that financial crisis does not occur again or something similar does not happen again. So he says that either CECL or capital regimes must be modified in order to avoid the adverse effect that CECL may have. Another one, if you look at the Credit Union National Association, they also said that FASB should review the standard and reduce necessary compliance changes, and as well as develop these resources in coordination with prudential banking regulators. So again, we're not trying to read a lot in between the lines, but at least what some of these comments suggest is that the banking or the financial institutions are saying that, they should probably talk more, like, by this quote. And finally, there is a congressman as well. So there was actually a lot of discussions on CECL, and Congressman Blaine said that for publicly traded firms, they should amend the final rule so that it takes into consideration the existing bank capital regime, which already require institutions to hold capital against expected losses. So the overall theme of these discussions is that it is kind of a duplicative effort. That after the Dodd-Frank Act, the federal regulators have already, prudential regulators have already created this kind of framework which limits, banks, or I wouldn't say limits, which actually kind of keeps banks and lending institutions in check by creating these regulatory capital ratio requirements or the stress testing requirement. So finally, when the regulatory response came, and this is like another quote, and again, as I was talking to Professor Srini earlier, it's very difficult for us to say explicitly like this is why it happened, but we are just relying on some of this anecdotal evidence, which says that, for example, here it says that in response to the uncertainty, the banking regulators are now proposing to allow banks to option in over, phase in over a 3-year period. So again, this is just like an anecdotal evidence for our story, to help us, claim that, whatever we are observing here is due to the uncertainty that happened because there was not enough coordination between two set of regulators. Okay. And then, so what we do is we have two research design settings to tease out this effect. First is we look at the period of Jan 2014 to, March 2020, and we stop at March 2020, of course, for several reasons, because CECL was going to get implemented in March 2020. And at the same time, COVID happened in March 2020. So we don't want to look beyond 2020. And we define the period between June 2016 to December 2018 as the uncertainty period, where uncertainty indicator is 1. And the period before this is where we say uncertainty indicator is going to be 0. And again, to further elaborate on our results and further provide more concrete evidence, what we do is we also create 2 subsamples where we say like this period, we call it as the uncertainty period, where, this is the pre-uncertainty period and this is the post-uncertainty period, and which is before and after a FASB issued CECL standard. And then the second sample that we look at is basically this period, which we call as the resolution period, that after Fed and OCC announced that, banks have 3 years to phase in, then we say that, uncertainty went away. So we create one ASU or FASB sample and and the Fed sample. And one of the fundamental challenges in this analysis is, of course, the identification of this effect. So what we have done is we are using non-banks as control and our treatment forms of banks. And while CECL is applicable for banks and non-banks both, let me just say this is a disclaimer, it is applicable for both. But the thing is that non-banks are not overseen by Fed regulators. So they don't have to comply with regulatory capital requirements, or they don't have any stress testing requirements, etc. In fact, there is this quote by a Lieutenant Governor of Washington, where he says that banks and credit unions are overseen by Fed regulators, but non-banks don't. So you are introducing the standard which may have adverse effect on banks, but not necessarily on non-banks. So we are again using some anecdotal evidence to, create our research design here.
So one question, Kirti,
yes.
Again, it's a clarificatory question.
Sure.
Do you have any descriptive on what these non-banks are? Which are they like insurance companies, other financial
pension
institutions,
funds, yeah,
pension funds, etc.?
Yes.
But is it safe to say that they have? I know they're not regulated by these 3 regulators. That's fine. But it's possible that the insurance regulator, and the other regulators of pension funds are also not acting. And so they are also contributing to this so-called coordination failure. So is this?
Yeah.
So
that's a very good point, actually. Yes. Okay. Yes.
Right. So you want, actually, ideally, you want to have as a control. I don't know if this is correct or not, but I'm just thinking this aloud, this out aloud. That you want a group of control firms for which there is no uncertainty from a regulator point of view, right? So maybe you, if you have even if a small subsample where the regulator has clearly said that they are okay with what the FASB is, we are in sync with the FASB. That means there's no uncertainty. So that will be the ideal control group. But if there is some residual uncertainty for the other control firms also, then again, the attribution becomes a little murky.
Yes, I agree. And I think that's a very great point. Like we haven't really thought about, we didn't even look at the other regulators for non-banking institutions. So that's a very great point. We can definitely, we'll take a look at that. And yes, in fact, again, when we started this project, like earlier, I was just, we were gonna show like some, some OLS regressions without like any definitive designs. And then we said, we'll try to tease out the effect by looking at cross-sectionals. And then as we were reading along, where we saw these quotes, and, there are like some Wall Street Journal articles as well that talked about that, how non-banks are not getting affected. Like we read these things and I said, oh, can we use this? So I agree. And it is, again, it's the first time I'm presenting this paper. So I'm really excited that you're giving us these comments, because it helps us really improve it further. And so we will definitely do that. And we will, again, maybe think of more appropriate control. But yes, like Riddha and I think we have had so many discussions about this particular thing. We're like, oh no, should we use this? No, this doesn't work. But point taken, particularly your point related to who are the regulators for these non-banks. And if we can find some sort of comfort by, that shows that, at least they were in sync with the accounting regulators, that will be perfect.
Yeah.
Thank you. Okay, so in terms of our data, we rely on Thomson, Reuters, deal scan data. And based on, this is I think a JFE paper, Iwashina and Sun 2011. So this is a loan level data. So each individual borrower who, they borrowed from, etc. And then it has a loan type. So if it's a term loan A, it's typically a bank loan. And if it's a term loan B, it's typically a non-bank loan. So that's what the classification that we use. Similarly to Iwashina and Sun, and also I think there are some recent papers that have used it. In terms of financials and stock returns, we look at Compistat and CRISP, and we also do some textual analysis where we use SEC Edgar. So here are the main results, and this is based on the research design 1, where we said that the period between 2016 June to 2018 is the uncertainty period. Uncertainty indicator is 1. And then here uncertainty indicator is 0. So this is the first design where we combine the pre-uncertainty and post-uncertainty in one, and we call it no uncertainty period. And as you can see, okay, what we find is that for banks, there is a reduction in the loan amount. There is an increase in spread. And we also see some slight increase in the collateral requirements. And this is a specific real estate collateral. So our one of the things that we wanted to see was like the hard collateral, right? And as there was a comment earlier where I was asked whether we are looking at any tangible, intangible assets. So one way we tried to tease out this was looking at the real estate collateral, which is a hard collateral. And this analysis is at the facility level. So when I say facility level, it's like one borrower borrowing in one particular date from a particular lender. And we have used like several fixed effects as well to ensure that we are controlling for several omitted variables that may have effect on our regression on our estimates. And then what we do is we divide the sample in two parts, which, as I said, this is the uncertainty sample and this is the resolution sample. So what we do is we say that pre-uncertainty and post-uncertainty, we find that banks do reduce loan amounts, they do increase their spread, they do increase the collateral requirements. But when you look at the uncertainty versus resolution period, once the Fed has given the clarification, there is some sort of a reversal that we see. We actually find that the amounts go up and the spread goes down. So this does provide a little bit of a validation for our story, which is that there was, of course, uncertainty due to the regulatory coordination failure. And once that uncertainty not resolved completely, again, I'm not claiming that it was resolved completely, it was resolved to a certain extent, but it did have some sort of positive impact on the banking industry.
One quick clarification on this collateral variable. How was it measured?
Like it's an indicator.
Indicator, is
So
it? Whether they use a collateral. Yeah,
yes.
The reason I bring it up is I think in your favor, you're saying that they are using more collateral, right? Because of the uncertainty. Right? Because you may be familiar with this paper by Raghuram Rajan and others, which is, I think, forthcoming JFE or JF. And they essentially document over a very, very long interval that the use of secured debt has come down.
Yes. Yeah.
So this is kind of given, I know it's not like a major point, but you can still say, in general, it's trending downwards. The use of collateral, use of secured debt in the US. So the fact that the sign goes in the opposite direction is somewhat in your favor.
So, that's okay.
And I also have maybe a silly question, and I don't know if you would want to answer it, but when you have year fixed effects, you don't need a trend term, right? In your right-hand side. All I'm trying to say is, suppose in general, the use of collateral has been coming down over time, and you want to capture it, capture that trend. Do the year fixed effects take care of that?
Yes, it should, right? I mean, if if during this period, for whatever reasons that were unrelated to CECL standard.
I'm not 100% sure, but I'm just because I have a similar question in another setting where I introduced both the trend term and it did load a little bit. So that's why I had a question. Maybe my econometrics is wrong.
No. I always, every time I'm including any fixed effects and everything, like I think a lot. I said, what am I capturing? So it's it's always good to think about these things rather than like just throwing them in there. Yes. Then we also do lender level analysis, where we kind of consolidate things at the lender level. And in fact, we find that the results are stronger when we look at the lender level results. And we find that specifically banks compared to non-banks, the previous results were at the facility level. So it was at the loan level. Now we combine things and we find that for banks, we do find that similar results, that amount goes down and spread goes up, and a real estate collateral goes up again significantly. And here is what, this is again to get like some comfort of parallel trends between banks and non-banks. What I'm plotting here, the loan amount and loan spread. And as you can see, these coefficients are actually not significant, and this is almost zero. But then after 2016, the amount goes down significantly and kind of goes up. So again, this is basically the difference between the bank and non-bank. The points that you see here are the coefficient of the regression, which was run for yearly basis, and it shows the difference between banks and non-banks. So it shows like that the difference was not much between 2014 to 16, and then there is like significant drop, and then it went up again. And similarly, we find similar thing for spread as well, that here you see that there was not much difference in spread between banks and non-banks after controlling for a lot of lender level effects, etc. And then it went really high and it came down. So again, this is kind of a validity in terms of like parallel trends for our research design, which makes us feel better that okay, non-banks is not as bad a control. It's probably a pretty decent control for this setting. And then we do the similar thing. We divide the sample in two parts, and again, as you can see, the results are pretty much consistent. And in fact, like if you see at the lender level, we see that even not just the real estate collateral, but overall collateral requirements shoot up. Like that's what the result shows in the uncertainty period. And in fact, here we find that in the resolution period, the uncertainty requirements go down. So, sorry, collateral requirements go down. Yes. Professor Srini, you're on mute.
Yeah, sorry, Vamsi has a question.
Yes, Vamsi.
I wrote it in the chat, like when we talk about these loan amounts, so do we talk about the short-term debts and the long-term debts, the timeline of the loans also? Because as someone already pointed out regarding the tangible assets and intangible assets, there is again a link between the short-term debt and long-term debt again with the tangible and tangible. So when we talk about this loan amount, what exactly are we talking? Are we talking about the long-term debts or the short-term debts, or what
so
exactly?
our sample is all about long-term debts, and that's why we're showing you the term loan A and term loan Bs, right? So it's all term loans. So these are all long-term debts. So we're not looking at any short-term debts here. Yeah. Okay, and then what we do is we look at the real effects, and where this is how we define the treatment firms, that they have exclusively borrowed historically from banks. We call them treatment firms, and the firms that have borrowed from banks and non-banks both in some proportion, we define them as control firms. And again, we have one of the reasons why we did it is we could have just done this, like we could have said that the firms that borrowed exclusively from non-banks would be our control firms, but there are very few firms. So I think we did not have like enough control firms with that. So that's the reason we modify it, but we are again open to suggestion if we can improve our research design in some way. So right now the idea is to say the exclusively borrowed from banks and the firms that borrowed from banks and non-banks both historically. And what we find is that we see that there is, I think there's a question from Debalina.
It's regarding the previous slide actually. So when you say that they are both like, so there are very few firms that are exclusively borrowing for non-banks. So what's the threshold where you stop, where you say that exclusively they are borrowing from non-banks? Because all of them mostly borrows from banks as well, right? So like, what do you think is a good level, and what are you using as a good level? I mean.
Sure. In fact, like I think so, I didn't put the summary stats here. It would have been nice to put it here, but it's in the paper. But the thing is that we are saying that historically, so our analysis period runs from 2014 to 2020, March 2020. And what we say is like between 2010 and 2014, like, this period, if you exclusively borrowed from banks, and the reason why we are using this is that non-banks typically have, higher, again, like I worked in India with G Capital a lot. So I was, part of a non-bank. So I remember one of the things was that we always charged higher spread compared to banks. Our borrowers were very, very different from those that, went to banks. We also had higher collateral requirements, etc. So which we see in the US as well, that, firms that go to non-banks typically have to post higher collateral. They typically have to, in fact, like they are in 96% of the cases, you'll see it in the summary stats that the non-bank facilities have 96% collateral. So they're typically heavily collateralized loans. They are very, they charge higher spreads, etc. So even if you did borrow from banks sometimes, but the idea that you borrowed from non-banks means that you were willing to pay those higher spreads during this period. So we are just looking here. It is basically a consolidation of your loans between 2010 to 2014 and how much proportion came from banks. If it was 100%, then we define you as treatment firm. If it was anything less than 100%, we define it as treatment control firm. And we have done some robustness checks, which are not in the paper, where we say that if you borrowed 50% from banks and 50% from non-banks, the results are pretty much similar. Does that answer your question?
Yeah, sure.
Okay.
Chavi has a question. Yeah, go ahead, Chavi.
Yeah. Hi, Kirti. It's actually on the next slide. I was just wondering, do you also look at the change in borrowing pattern when looking at the borrower level results? Like you talk about the outcome in terms of investments, but do the borrowings, the spread between the short term, long term, whatever, does it also change? Is the borrowing getting affected? Because for me, if I understand it this way, investment is something that comes later, but intermediate could be to look at how is borrowing getting affected and then how it translates into investment.
Okay, yes, okay, very awesome question. In fact, I think what you're saying is basically when, lending is going down in the market, we are kind of missing a link here that, it's affecting, right? So this is the investment link and this is a, lending market link. And here is the link that you're talking about, that is there some sort of, maybe, what do you call, like the allocation of debt is changing from here to there, or are you raising more equity, right? Yeah.
Yeah, it
so
would
we
be
haven't done that, but
channel. Yeah. to understand.
We can try to look at that. Yeah, that's a good question. Yeah.
Okay, thank you.
Okay. So what we find is that we do see that there is a reduction in investments when you look at like the capital expenditure or R&D expenses overall. Again, we do like the combined sample, then we divide the uncertainty and the resolution sample. And of course, we don't see any reversal, which could also be because, you know, investments are typically sticky. It's not that you will see a reduction immediately. So therefore, I mean, that's our conjecture again. And then here is like, again, parallel trends that we ran. And while you may see a slight decline here, this is not statistically significant, but we are thinking whether it could be because there were a lot of discussions about CECL at this point in time. Like, I think 2015 is when CECL standard was being discussed. So like, did it already impact bank lending in some way? We're not sure. But in terms of statistical significance, this is not significant. So we do see that the firms that were borrowing from banks, exclusively from banks and other firms, they were pretty similar in terms of their investments. And then it kind of went down a little bit, and you know, it did not really improve much, even after the resolution period, you know, even when Fed provided some resolution. Okay. And then we did some cross-sectional tests where we looked at, you know, whether if you're a frequent borrower, so if you've borrowed a lot, that means that you are dependent on, you know, banks. And we find that the results are actually much, you know, you have slightly more, reduction in investment. And in fact, there is some sort of a reversal as well when we look at frequent borrowers in the resolution period. And then this is something I talked about, availability of the public debt rating and the borrower size, which are both proxies for firms that are, you know, maybe less financially constrained, right? So more financially constrained. So the firms that are not rated and firms that are small, we say that, you know, they are more financially constrained, and we do find that the results are in fact concentrated in this sample particularly. And in the interest of time, I'm just going to quickly show two tests, like very quickly, because I think I've got 2 minutes or something. Yeah. So what we did is, again, to support our story about the uncertainty, we examined the market reaction to these two events for both banks and non-banks. And we say that, you know, if our conjecture about uncertainty is true, then for banks, we will see a negative market reaction when FASB announced the standard in 2016, and there should be a positive market reaction in December 2018. And we do find that here, in fact, that it was negative. In fact, there was no significant market reaction for non-banks when FASB announced it, and the difference is statistically significant. And when Fed and OCC provided clarification, in that case, there is like a positive market reaction, which is slightly more for banks. Again, it is not statistically very significant, this difference, but it provides like some sort of validation that these two events did have some sort of impact on CECL related implementation.
One question, Kirti,
yes.
I would have thought you would have done some kind of test on volatility, right? Because your whole paper is about uncertainty. This is a mean effect.
Yes.
I know Sugato is into real effects, etc. But the thing is, it seems like the first thing that came to my mind is to look at how did the volatility change for the banks, for the borrowers, same pre-post, diff and diff design. And so the mean effect is saying that the markets didn't like the standard and then they're happy about. It doesn't really explicitly talk about the resolution of uncertainty, right? So some kind of looking at return volatility over a, let's say, a 12-day window around or a 10-day window makes a little more sense, I thought. Right?
That's a very, that's a good suggestion, actually. Yes, we can definitely implement that. Yes, we should have, but yes. And as a second validation, what we do is we also do some sort of textual analysis where we extract paragraphs from both banks and non-bank 10Ks. 10Ks is basically the annual reports of firms here, and between 2016 to March 2020. And we say that during uncertainty period, what the disclosures look like, and in the post-uncertainty period, again, we are stopping here in March 2020 to see what disclosures look like. And we examine the probability of disclosure about CECL and the disclosure attribute. So here, actually, this is like a quick example, again, very small font. I don't want you to read into it. The only thing I'm trying to show with this slide is that this is Wells Fargo's 10K during the uncertainty period. So where they, they just said that we are evaluating the impact, we expect this will happen, but like there's not much information that has been given here. But after uncertainty period 1, there was a resolution. They say that, we expect, like they're really talking about we'll use ACL like this and etc. So there's like much more discussion of what they're going to do. And again, some of you may say that, yes, of course, a lot of time has passed that since the announcement of the standard. So banks have thought about it a lot more, and that's why they're talking about it a bit more. But in this, that's again a caveat for this analysis. But we do some sort of analysis between banks and non-banks, where we say that the use of uncertain language was higher for banks compared to non-banks during the uncertainty period compared to the before. So this is basically a 2x2 where we are doing the pre-uncertainty and post-uncertainty and bank and non-bank. And these measures are based on McDonald-Laurin dictionaries, where we pick up the uncertain words from the 10K, specifically from paragraphs where they discussed the CECL standard. And we also did some sort of like time series analysis, where we say that during the uncertainty period, the length was much smaller. The use of term CECL, it's an indicator variable that shows was less. Their tone was typically negative, and they did not provide any numerical or dollar numbers. Again, these are just like some tests to support our story that that there indeed was some sort of uncertainty that resulted from lack of coordination between accounting and prudential regulators. And again, I think I'm almost over time, so I would just conclude that in this paper, we examine the real effects of coordination failure, and this is one of the first empirical papers that is providing some sort of real effects that arise from coordination failure between accounting and prudential regulators. This paper also contributes to the literature on this, this nascent area of CECL, because now that CECL has been implemented, there has been a lot of research which is going on. While we don't examine the effects of post-CECL implementation, we still show how CECL-related uncertainty has real effects. And finally, our study has implications for industries that are regulated by multiple regulators, and how the coordination is very, very important. So thank you very much, and it's been a pleasure.
Thanks a lot, Kirti. I think Debolina has a question.
Yes.
It's just like more of a generic kind of a question. So the first time when you say that it's like this is one of the first papers, so have these been like studied in the context of other countries? Because this seems like a problem that will be, relevant to a lot of nations, So
no, I agree. Yeah, so at least like based on what, and that's why I say it's one of the first papers. I'm not saying this is the first paper, like that's the reason.
No. I just want to know, like, what have you looked at, and like, has there been anything like I don't want to point out on your points, like.
No, and I agree, but we, at least whatever we know, as far as like whatever literature review that we have done, we haven't seen anything. Like it's mostly the theoretical literature that exists in this area and that talks about the implications. But empirical evidence, we haven't seen that yet.
Yeah, cool.
Great. So thank you very much, Kirti. It was a pleasure having you over at online in India. So I hope you will be able to travel when all of this dies out, and present a paper when you come here. So invitation to all others from who are on this call, like Shivani, and I forgot your co-author's name.
Riddha.
Okay, yeah. So you're all welcome to come.